Imagine an 18-year-old waking up today after a 30-year coma. They would marvel at the ability to video chat with someone in Tokyo instantly, only to find that sending that same person money still takes 3 days and a 7% fee. We have built sleek mobile interfaces, but the core system underneath relies on ledger technology that hasn't changed since the era of paper passbooks. This friction acts as a global toll booth, trapping capital in transit and dragging down economic velocity. To process a single international wire, a bank must move data through layers of front, middle, and back office staff. Most of that cost goes toward reconciliation, a manual process where armies of employees check separate, disconnected databases to ensure the numbers match. Because banks lend out 90% of their deposits, the true state of their reserves remains hidden from the average consumer. In practice, traditional banking is an expensive, fragmented database that requires constant human intervention just to establish what is true. Blockchain and stablecoins provide a direct technological replacement for the bank's core product, the ledger. Immutability creates a single, shared record of every transaction, which makes middle office reconciliation obsolete. Traditional markets rely on T+2 settlement, forcing buyers to wait 2 days for a trade to clear, while bearing the risk of market fluctuations. Atomic settlement allows trades to clear instantly and allows the market to operate 24/7, removing the limitations of bank hours. By replacing manual verification with code, these systems remove the middleman's margin and can drop fees to a fraction of a percent. Cryptography replaces the opacity of fractional reserves with 100% on-chain transparency. Proof of reserve allows any user to mathematically verify an institution's assets at any time, removing the need to trust a bank's internal reporting. The world's largest financial institutions initially criticized this technology, but they are now adopting it to maintain their competitive edge. Larry Fink has transitioned BlackRock from a sharp critic of crypto into a primary driver of its underlying infrastructure. At JP Morgan, Jamie Dimon's team is now using tokenized deposits to streamline how their corporate clients move money. These migrations are happening for a pragmatic reason. The mathematics of the new system are undeniably superior. The core financial tool for the next generation is the digital superwallet. Agentic AI will drive mass adoption of this tool. As autonomous assistants begin managing our personal budgets and vendor contracts, they require their human owners to hold a compatible financial endpoint. AI agents cannot use traditional bank rails. 3-day delays and 7% fees make instantaneous microtransactions between machines impossible. Stablecoins and low-cost crypto transfers serve as the default currency for this AI-driven economy. The next iteration of the internet requires money that moves exactly like data, making traditional banking architecture structurally incompatible with the future. Regulations and human habits will influence the speed of this transition, but they cannot stop the technological advancement. Current skepticism of digital wallets mirrors the hesitation many felt during the early days of the internet. Future generations will view a physical bank account with the same curiosity we feel toward a fax machine. Blockchain is an infrastructure upgrade that changes the global economy from the bottom up. We are moving past 5,000 years of relying on centralized middlemen and toward a financial system governed by immutable code.